Financial ratios, etc. There is no point in producing either the profit and loss account or the balance sheet unless we can use them to our advantage. We can get from them certain useful ratios. So, what are ratios and why do they help us? Look at these health pictures that give a waist to hip ratio. The point is that whether you are a big person or a small person, the healthy ratio is the same. The same argument applies in comparing a small company with a big company. We are interested in the working capital ratio, also called current ratio. This is how many times your current assets are bigger than your current liabilities. Put another way, how many times the value of what you own short term compares with what you owe short term. Working capital will be big for your Bransons and small for your Arkwrights. As soon as we do a ratio, we have a level playing field, and size does not matter. Using the figures in our working capital, we have £96,000 compared with £16,000. This gives an unrealistic 6 times, or 6 to 1. The experts say that the ideal ratio should be around 2 to 1. Now think Northern Rock. Why was there a queue of people? They wanted their money because the news on the grapevine was Northern Rock is in trouble. The customers wanted cash, and cash only. Suppose a similar situation arose in your business. Would the creditors accept anything except cash? So you have to discount stock when doing the acid test ratio or liquidity ratio. Using our figures, we have to knock off 24,000 from the 96,000 total current assets. This leaves us with £72,000, which is £20,000 in the bank and £52,000 that we ought to be able to screw out of our debtors who have our money in their possession. We now have to compare £72,000 with £16,000, and the ratio is 4.5 to 1. Obviously, the minimum that the acid test ratio can be is 1 to 1. That is, our liquid assets just cover our debts.